Hey friends, how's it going? This is the 0DTE market analysis, and it's Thursday, December 26th. We are deep into, well, we're not deep into much, but what I wanted to talk about today was the Santa Claus Rally and what it's all about. And then we'll get to what we normally do, and that's figuring out exactly what we're going to do for the day with our trades. But and the Santa Claus Rally is going to fit into that very nicely. So what it is, it refers to this kind of historical phenomenon where the stock market and equities tend to rise during the last 5 days of December, the last 5 trading days of December. And in the first 2 days, well, it would include the last 5 days of December and the first 2 days of January, usually. Something like that. And it's a fairly widely known and talked about phenomenon. And the reason for that is because of its potential. So what I'm going to do is I'm going to provide a pretty in-depth background of what the Santa Claus Rally actually is and why we are paying attention to it. Normally, I don't really pay attention to any kind of seasonal phenomenon because they don't have a super high percentage of actually occurring. But my standard for any kind of seasonal thing or other type of thing that people say has some statistical significance, it has to have at least 2/3 or about 67-68%. But in this case, the Santa Claus Rally, I mean, it's really incredible. It's about a 78% that it happens with about well, we'll talk about that. So it's the seasonal tendency for stock prices to rise during that specific period that I talk about, the last 5 trading days of December and the first 2 days of January. Now, over the past century, the U.S. stock markets in the S&P 500 have averaged, get this, 1.3% up during that period. Now, it's pretty distinct from broader year-end rallies because of its shorter time frame and higher degree of reliability compared to other seasonal trends, and that's what is really the kicker. Now, why does it occur? The reasons for the rally aren't entirely clear, but there's a lot of theories, obviously. Some people think it's psychological, institutional, or that there's technical drivers. From an institutional point of view, there might be tax considerations, what some people call window dressing at the end of the year. They want to pad their book. Fund managers may adjust their portfolios at year-end by buying winning stocks to improve the appearance of holdings, looking for those year-end bonuses. And some think that it's because of tax loss harvest ends. And, there's no more reason to get out there and get rid of all of your losers because you've already done that well in advance. And that typically would end in mid-December. Now, this removal of selling pressure can lift or help lift stock prices. So often also during this time, because most of the institutional guys are probably in their houses on the Hamptons, there's an increased activity with retailers. You might say that they're going through holiday cheer, and there's a festive mood and optimism about the coming year, and particularly after maybe an election year, and a lot of people are encouraged by what that year portends or what that term portends. Might also be because of bonuses and year-end cash. A lot of people receive their year-end bonuses and payouts during that period. And so maybe they think that investing in the market is the best way to go. There's lower trading volumes, so the liquidity is much less. So institutions can push things around a little bit more. So institutional traders and professionals on vacation, market volumes are lower. This can result in reduced resistance to upward price moves. Optimism about the new year, as I just said, often there's a sense of optimism tied with the new year calendar, leading to kind of a bullish sentiment. Historical performance. The stock market analysts have tracked the Santa Claus Rally in financial media for decades with some key statistics. Historically, the S&P 500 has posted gains during this period of approximately, at least in the last 20 years, it's been about 78% of the time, but over the long period of time, it's been about 75% of the time. Now, when the Santa Claus Rally fails to materialize, it's often seen as a bad omen, bearish signals for the market in following months. There's a little saying that says, if Santa fails to call, bears come to Broad and Wall. Broad and Wall, that refers to Broad Street and Wall Street down in that area in the financial district in New York City. There are some limitations or criticisms to all of this. And while the Santa Claus Rally has a strong historical basis, it's not guaranteed to happen every year. That's what I always like to say when I'm talking about these seasonal trends. Yeah, sure, it has like a 65% chance of happening, but it doesn't mean it's going to happen this year. Let's just stick to our strategy. But this is a little bit different. Because of its super high level of statistical prominence, up in that upper 70s range, I think that it's definitely worth the shot, especially considering what we're going to see with what's happened with the market so far. But from a statistical point of view, it's got a really small sample size. Any kind of specific small 7-day window, that's a relatively short period, and it's prone to randomness. So other influences that I can think of are broader economic conditions like geopolitical events, the Federal Reserve policy, although that seems to be a deterrent this year because markets have been largely disappointed by it. But it appears that the rally is overcoming that disappointing news by Uncle Jerry. Other things, there could be overhyped expectations. The financial media's focus, the talking heads on CNBC and Bloomberg or Doomberg, can lead to a kind of confirmation bias. So how are we going to trade the Santa Claus Rally? Well, we're going to go with long, out-of-the-money butterflies. Simple as that. Do we go with wider flies, narrower flies? I'm going to say mid-tier, but we'll look at that right now. So we'll do our normal market analysis. Hopefully that was informative for you for the Santa Claus Rally. But in the beginning, we were talking about this last week. Someone had mentioned the Santa Claus Rally, and I said, well, historical rallies, I'm not really a big proponent of those because of the small sample size, and hey, let's go with the strategy. Do what sounds the right thing to do. It turns out, though, that because of where we are and because of our normal analysis, we would have gone with it anyways. But I am putting that aside and saying it's a good bet. All right, so let's get on to the analysis. First, we look at the VIX. The VIX is super low right now at 15, meaning that we typically go for a 10 or 20 wide fly. I'm going to say that you can go 20, 25 wide on one of these rallies, and just make sure it's far enough out of the money that we get that 1 to 9, 1 to 10, up to a 1 to 12 risk to reward. So push it pretty far out of the money. We've had some really expanded range in the past few days, so I think that's a good bet. Let's take a look at where the market actually is. Well, what do you know? We are in an uptrend, according to our analysis. It's above the moving average. At least that's the way I view it. Some people will look at the slope of the moving average and say, oh, we're still in a downtrend. But it's clear that, look at this expanded range, that we've almost completely taken out this move down because of the hissy fit that the market had, because of Uncle Jerry's prognostications. So of just fewer rate cuts in this coming year. But it looks like the market doesn't care, right? There is no big ass fly this morning, so we can forget about that. But let's take a look at what things look like right now. So we're going to be looking for, instead of resistance, we're going to be looking for a pullback into one of these structural levels. So maybe when we get into the market, if we look at something like this here at 60.76, or maybe down to here at 60.42, we'll see if there is a pullback, in fact. But we're looking for any opportunity or event where the market pulls back into one of these structural levels and then go long. So there you go. Back to the big head. I want to thank you very much. That's what we're doing today. Long call flies, out of the money, going with the Santa Claus Rally, even though it's pretty much in line with our strategy. So that's the way we've been playing it all week. Of course, yesterday and the day before we had it off. Some members did decide to trade on the half day and they on Tuesday, and they actually did quite well. I don't want to forget that in the beginning of the year, we're officially launching our Zero DTE Academy. It's a school-based community where you can learn all about our strategy. It's going to be a fantastic service, and it's the first step into the world of Zero DTE trading. So if you want to know how to best control your risk and go for those outsized returns in an asymmetric strategy, learn how to trade like a professional, then check this out. It's only $35 a month. The link will be down below. Other than that, I want to thank you all. We'll see you tomorrow. Go Santa Claus! All right, take care.